Well, I've been saying for a long time that my vision was, I was thinking that it would be about $180,000 this fall.
Hmm.
Now a lot of things have happened since then. Yeah. See, here's the global liquidity. This is again, Michael's chart and this is, staggered. So Bitcoin is actually, I think 6 to 8 weeks, uh, backwards here. So, it has to catch up. But, I think that what happens here, Danny, is that we have a lot of tailwinds that may push that forward,
Hmm.
the 180,000. I still think that we can see it this year. We could easily double.
Over the past few days, Bitcoin, BTC, has seen notable volatility, driven by a mix of macroeconomic factors, regulatory changes, and market sentiment. As of February 27th, 2025, Bitcoin is trading at around $86,500, marking a 2.83% decline from the previous close. The intraday high reached $89,400, but this downturn represents a significant retreat from its January all-time high of $91,350, a drop of over 20%. Several factors have contributed to this movement, including President Donald Trump's announcement of new tariffs on imports, raising concerns about inflation and the broader economy's stability. Additionally, Bitcoin exchange-traded funds, ETFs, have seen substantial outflows, with $1.1 billion withdrawn in a single day, signaling a shift in institutional sentiment amidst economic and regulatory uncertainties. Furthermore, the rise of meme coins and speculative assets has caused concerns about market froth and possible overvaluation. These developments have sparked speculation that the crypto bull market may be over and a bear market could be on the horizon. However, renowned analysts argue that these are merely short-term challenges that will soon be resolved. In a recent interview with What Bitcoin Did, former hedge fund manager and Bitcoin advocate James Lavish discussed a critical factor he believes will drive Bitcoin above its current all-time high and toward $200,000 per coin in 2025. Lavish, who focuses on global liquidity and its impact on risk assets like Bitcoin, suggests that liquidity, not these temporary challenges, will be the primary force driving Bitcoin's price in 2025 and possibly into early 2026. His analysis draws heavily from a recent discussion with Michael Howell of Crosby Capital, a veteran financial market analyst. As we share highlights from Lavish's interview, please take a moment to like this video, subscribe to our channel, and turn on notifications for more content like this. Thanks for your support, and enjoy the video.
So Michael Howell and I got together and we talked about liquidity. And, Michael Howell is, from Cross Border Capital. To me, he is the, leading analyst on the leading analyst on global liquidity. The guy knows what he's talking about, and he follows this stuff very closely. He's got proprietary models that are powerful. And so we talked for a little over an hour. And so a lot of what my piece is of that newsletter that you're talking about is kind of going just a little bit deeper than our conversation. We kept it pretty high level for everybody to understand it. So, so what we talk about, what we mean when we talk about global liquidity is just, you hear about like M2, the money supply and, how that's driving the stock prices and sometimes, and of course real estate and so asset prices basically. And so, but where's that come from? Where's that? Is it the Fed printing money? Is it, is it banks lending money? Like, how is there more liquidity? Is it hedge funds, using derivatives? Is it cross-border transactions and lending? Like, how does this actually? And the answer is it's all of it. And so you have to look at all of it to try to get a sense of how that money supply is either increasing or decreasing. When we talk about the money supply and the expansion and contraction of it, like first principles, first of all, our central banks have manipulated the money and they've created an absolute disaster with the amount of manipulation that they're doing with the money supply.
Hmm.
They're either adding it to the market or they're taking it away. And when they do that, you have these booms and busts of economic cycles, which are not really as natural as they should be. So we talk about the money supply. Most people think, oh, is the Fed printing money, or are they taking it out? So are they doing QE, quantitative easing, where they're printing money and out there they're out there buying bonds and U.S. Treasuries and mortgage-backed securities in the open market, or are they doing QT, quantitative tightening, where they're selling their own securities from the Fed, from the Fed balance sheet, they're selling them into the open market, and that will take money out of the system. So when you're buying it, you're injecting the system with capital that wasn't there before. They just print it from the Treasury. It's not really printing. What they do is they press a button and it shows up on the Fed's balance sheet. The Fed gives it to a bank. The bank goes out there and buys it. It ends up on the balance sheet of the Fed. And that's kind of how they do it. Recently, what they've been doing is quantitative tightening, because we had lowered all the interest rates down to zero, and we had printed all that money and bought all those bonds. Then when inflation spiked up over 9%, the Fed raised rates and they stopped doing QE and they turned around and started doing QT, which means that they were taking money out of the money supply by selling bonds, the bonds that were on the Fed's balance sheet, into the market and taking that capital back out. But other things that people don't think about that Michael's done a good job analyzing, and this is all his proprietary models, but he also adds in their bond volatility. So these are all the things that go into global liquidity. So bond volatility is important because people will use their treasuries, they'll use their bonds as collateral, right? So they'll put their bonds to somebody, lend them to somebody, and they'll borrow cash for those. And how much cash they get for that, the loan to the underlying value, right? Depends on the volatility of that instrument. Mm-hmm. So if the bond is really volatile, well, they'll lend less money because it's more risky. But if it's not as volatile, they'll lend more money, right? So the loan to value will be much higher if it's less volatile. So the volatility really does matter. And that's just another aspect of that calculation. I don't have the calculation, but he's got some incredible charts about it and how these liquidity cycles move. And what he's found is that they kind of move in 5 to 6 year cycles. And in this latest cycle, it looks like we bottomed out in October of 2022. And now the liquidity is coming back. Like, all the central banks were drawing capital out of the system, and that peaked in October 2022 with not just that, but bond volatility, lending practices were down. It's all that goes into it. And so now it's kind of turned back up. You get more confidence in the economy. The central banks stop tightening rates and they start lowering rates a little bit. The lending picks up and all of that. So, and then it kind of turns back up, and it looks like we're in the upswing. And if you do that 5 to 6 year period, it looks like we're gonna peak in liquidity somewhere around the end of this year to beginning of next year.
One of the most intriguing elements of Howell's analysis on global liquidity is his concept of not QE. This term refers to central bank actions that, while not officially classified as quantitative easing, have a similar effect of boosting liquidity in financial markets. These measures can include short-term lending facilities, adjustments in repo operations, or other interventions aimed at injecting liquidity, but without the formal designation of a QE program. Howell highlights that, in a global economy burdened by excessive debt, such interventions are crucial for maintaining financial stability. He argues that the large balance sheets of central banks have become a necessity, with the distinction between QE and not QE becoming increasingly semantic. According to Howell, the massive levels of debt in the modern financial system require ongoing central bank support. He points out that much of financial market activity revolves around refinancing existing debt, not facilitating new investments. This means that any reduction in central bank balance sheets, as seen with quantitative tightening, could destabilize markets. Therefore, Howell suggests that central banks are likely to continue, and potentially even expand, their liquidity provisions, effectively perpetuating QE under different forms. He believes the persistence of these QE-like policies will have significant implications for investors, as continuous liquidity injections tend to inflate asset prices, significantly benefiting risk assets like Bitcoin and other cryptocurrencies. Here are more clips from the interview.
Yeah, risk assets definitely benefit the most from liquidity, and so you're looking at primarily the biggest beneficiaries are the high flying tech stocks, the S&P, and then of course Bitcoin has been an incredible gauge for global liquidity if you look back in time. The only thing is Bitcoin it trails liquidity, so if liquidity is up, then it takes Bitcoin somewhere between 2 and 3 months to catch up. So if you overlay those charts though, the Bitcoin chart and the global liquidity chart, man, they look really close. And so, that's what you're kind of watching, but it's a 3-month lag. So,
Okay.
right. So it's not a great indicator, but it absolutely is directly correlated today. This may not be forever. I don't think it will be forever, but today it is absolutely directly correlated to the money supply and liquidity.
So do you think as Bitcoiners, instead of paying attention to the 4-year cycle in such a great deal, because that obviously has diminishing effects, do you think liquidity is really the big driver of Bitcoin?
That's a loaded question, but it is absolutely, it absolutely matters. You have to have liquidity for an asset like Bitcoin over the last few cycles to expand and for that price to rise.
Mm-hmm.
Will that break eventually? That being so tied to the liquidity cycle, I believe it will. We're not there yet. We're in the middle of it still, but it won't break until there's a reason for people to own Bitcoin other than speculative.
Mm-hmm.
And at this point, most people just believe it's speculative. You and I know that that's not the case. You and I have a much longer view on this.
Yep.
And we understand that Bitcoin it's an important allocation to have in your portfolio for multiple reasons. One of them is not just to keep up with the money supply, because money supply drives inflation and Bitcoin goes up with the money supply and saves you from inflation. Now it will matter, but will it be the leading indicator or will it be the most important thing with Bitcoin? I don't think so. And eventually, it's not there yet though. When it happens, it's when Bitcoin is now taking market share from the rest of the global asset pool. Right. So right now it's been taking market share arguably from gold, and some from equities. Not a lot. I mean, there's $115 trillion of equities in the world, almost 120. And so, there's $120 trillion of cash. There's $330 billion of real estate and $300 billion of bonds. I might have those reversed, but the point is there's $900 trillion. I said billion. Did I say billion? I meant trillion. There's $900 trillion of total assets if you add those all up.
Mm-hmm.
18 trillion of that is gold. So when Bitcoin is taking from gold, but it'll eventually start taking from bonds, is my belief. And that's a little bit down the road, and we can talk about that a little bit later.
So you think then the likely outcome of this is QE happens in like relative short order, quite soon?
I mean, you heard what Bostic just said. They just basically said, we're going to stop QT soon.
Mm-hmm.
That's a signal that we need to get ready because we may need to be in the market again at some point here in the near future.
And what kind of form do you think that'll take? Will it be QE like we've seen before?
Well, it depends on what happens in the market. Is it a market shock? Is it something completely unexpected that causes turmoil in the bond market? If it's that, they're going to come out and just print money and buy. Mm-hmm. They're not going to care. They're going to stabilize the market. They will rationalize that we need to stabilize the market. And so that's what we're doing. But if it's a contained crisis, like they were able to create an acronym for, well, of course they would rather do that and call it.
They'd rather hide it.
I mean, they're doing it right now. It's not technically QE, but they have something called a regular treasury buyback program. So they're out there buying, treasuries in the open market from buyers who hold these illiquid treasuries. They're older treasuries. They call them off the run. And these are back in the day, the big bond traders, the banks, they would come into their desk and there'd be a big stack of it was like a long, you ever see dot matrix printers, Danny? You're too young, but where
Yeah, no, I know what they are though.
the
Yeah.
holes on the side and they just, yeah. Well, they had these huge runs of these printouts of bonds, and they had all the bonds in there, all the treasuries, all the mortgage-backed securities, and they would if somebody called and said, "Hey, what's the price of this bond?" There was no Bloomberg back then, so there was no pricing. Like there was no dynamic pricing for them. It was all on the phone, and there was no ticker for bonds, right? So at least you had stock tickers since way back when, since the Buttonwood tree, right? So, but there was nothing to look at, so they had to look at these papers, and so they'd look at the run and say, "Oh, this I'll pay you, 97, 0.5 for this one." Okay, but if they asked for a bond and it was like, "Well, it's not on the run. I have no idea. It's not liquid enough to even be in this massive stack," then it's called off the run. That means to be really illiquid. Well, now the treasury's out there buying those bonds that are off the run. They're just not liquid. And so why are they doing that? Well, they're creating liquidity in the market, making it easy for people to move their paper, and they're just replacing it by buying those and then issuing new ones. And so it's basically what's happening. Is that QE? Not technically. Does it add liquidity to the market? Absolutely. If you ask Michael Howell, he'd be like, of course it does. It's absolutely what they're doing. Is it a ton? No, but on the margin, it's adding liquidity, just like BTFP did.
In other news, President Donald Trump has announced a major shift in trade policy, imposing a 25% tariff on the European Union. During a cabinet meeting on Wednesday, he stated, "We have made a decision and will be announcing it very soon," adding that the tariffs would apply broadly, particularly targeting car imports. Trump criticized the EU, saying, "They've really taken advantage of us. They don't accept our cars. They don't accept essentially our farm products, and we accept everything of theirs." Let's be honest, the European Union was formed to screw the United States. That's the purpose of it, and they've done a good job of it. In the world of finance, BlackRock's Bitcoin Trust ETF IBIT saw record-breaking outflows on Wednesday, losing $418 million in a single day, according to data from SuValue. This figure far exceeds the outflows of competing Bitcoin funds. For example, Fidelity's Wise Origin Bitcoin Fund, FBTC, saw $145 million in outflows, while the ARK21 shares Bitcoin ETF, ARKB, and Grayscale's Bitcoin Mini Trust ETF, BTC, recorded losses of $6.46 million and $55.97 million, respectively. In total, Wednesday's outflows amounted to $754.3 million, and on Tuesday, cumulative outflows surpassed $1 billion for the first time. These outflows, coupled with the market reaction, have led to what data from CryptoRank suggests is the worst February for Bitcoin in nearly 11 years. The last comparable downturn occurred in 2014, when Bitcoin experienced a 33.7% correction. However, analysts like James Lavish are confident that a recovery is near for Bitcoin and other major cryptocurrencies. Raoul Pal, CEO of Real Vision, also believes Solana is primed for a significant price increase in March, noting that Solana is currently 2 standard deviations oversold on the log regression channel and has the lowest RSI since the 2022 lows. Pal stated on social media that the probability of significantly higher prices in the next month is wildly in favor of an upward trend, adding, "I have zero cash to add, but this is the sweet spot around here." Do you agree with Lavish and Pal's analysis that the crypto bull market is still intact and prices will recover sharply in March? Share your thoughts, comments, and observations in the section below. Also, don't forget to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.